Howdy, Team 42. It's your skipper here, Darius Dell, to present another episode of our Pro to Pro Live. I'm joined by our friend Ben Brey of Deductive Capital. How you doing today, Ben?
Pretty good, man. How's it going? Thanks for having me.
Oh, it's a pleasure to see you, man. I see you got the Wisconsin Badger in the background up there. Got some
I
Midwest
have
love.
to
I respect that.
represent.
I respect that, my friend. Well, for those who may not be new to you, you're obviously well known across the global buy side. But for those who may not be aware of kind of who you are and what you do, can you give us a little bit of background about yourself?
Sure, wouldn't say I am well known. I started as a traditional background, and I went to grad school and I ran a bond fund and I learned how to trade interest rates. And then I went to Fidelity in Boston and was an equity analyst. And then I made the calculated error of leaving to start to my own hedge fund in the summer of '08. And I was one of those guys who was bearish, but took the rookie mistake of not realizing you needed the extra liquidity if you're going to become an entrepreneur. So then I basically had been on the street, but running a family office, running different separately managed books and my own money since then in a firm named Deductive Capital. But I've traded books for firms from Singapore, England, India. And basically what I do is a combination of macro and traditional fundamental analysis. Most of my long portfolio is boring stuff that appreciates and has a positive carry, stuff like energy transfer, things that are not trading like Bitcoin, like things that you can hold and do well over time. And then I have an overlay of macro. And so I know we'll probably be talking about macro today. And I like talking, I trade interest rates and options and things of that nature.
Well, that's great, man. So this is you put together a phenomenal presentation that you're going to walk through. You and I had a great chat this weekend, and I was just blown away by the breadth and depth of your kind of understanding what's all happening out there in global macro, particularly from a very buy-side oriented lens. So without further delay, let's just hop right into this presentation, and I'll pick your brain as we go along. Is that okay?
Sure.
All right, cool, man. So Colin, if you throw up this first chart on the screen, and mute yourself if you don't mind.
Yeah. So basically, what this is, I was going through the idea here is the par value of the bonds and the market value of the bonds of the U.S. Treasury outstanding. And if you see during the bond bull market from 1982 to 2022, the market value was higher than the par value. And one of the reasons was that we had delevered quite a bit in the post-World War II period because it was the opposite before that. And then the regime has shifted again back to how it was in the post-World War II period till the 1980s. And so what does this mean? It means that the liquidity available for treasuries doesn't match the outstanding issuance. And if you look, it's almost $3 trillion, the gap. And again, this is held by global participants. This isn't just the banking system. They got stuck with some, pensions got stuck with some. Norinchukin Bank in Japan just announced they're taking a $63 billion loss on theirs. But these losses are in the system. And this is the base money of the global system. And it gets levered quite a bit. And there's not enough capital behind this to support basically, because you think about it, you post collateral and then you can have a bunch of assets in on top of this. And so this is in essence the seigniorage you see in the markets. And this is what the government has essentially taken. This is just the US. This is actually a bigger number when we use Europe and Japan and some of these other countries, but I'm focusing on the US. So I think it's like a nice starting point to say, hey, this is why the bond stock correlation has changed back to what it was when the bonds were worth less than the amount outstanding, essentially.
Oh, that's so interesting. Yeah. So is the obvious implication here that we're headed for some sort of destruction of capital?
So you see the second chart. This is like basically this is the more recent version of it. But what you see on fall of 22, fall of 23, and then most recently, you see how that red line gets a little steeper. And I think that when you think about fall of 22 and fall of 23, and then even this most recently, we had a period where the bear steepener starts coming and then things start falling apart. And then we get the pivot and the fund with bills and all the different mechanisms that I call the Treasury, but the Fed and the Treasury have done to keep it together. And it's interesting. again, I've traded Eurodollar futures for 20 years, and I've gone back over time. We've never had a period where at the top of the market, when we still haven't cut rates yet, they were forecasting cutting rates. It's always flat to up, essentially. This is the first time where we're forecasting cuts, and we've been forecasting cuts now for going on 2 years. It's pivot. The pivot's coming, right?
I got a chart for you on that. That is, I've got this hypothesis, and I'd love to hear your take on it, which is the UK LDI crisis back in the fall of 2022. I think permanently changed market structure in the sense that everyone knew that financing the government was the number one objective of central banks. It went from, inflation targeting and supporting their economies and the labor markets to supporting the bond markets. So in this chart here, it's a busy chart, but I'll just focus your eyes on the most important variables. The blue lines in each of these chart panels correspond to the 1-year overnight index swap rate minus the policy rate for the U.S. On the top panel, ECB, Bank of England, Bank of Japan, and Swiss National Bank. And this black dotted line here, going down the page, is the September of 2022, right when the Liz Truss budget was announced. And obviously, the ensuing weeks, we had a big blow up in the UK gilt market. And ever since then, rates markets across the world, with the exception of Japan, which is normalizing policy, have moved to start pricing in rate cuts. And this is when inflation was still 5, 6, 7% on a core basis in most of these economies. And so I think I agree with what you're saying. And I wanted to know if you sort of had a similar take.
Yeah, I think that's what happened. I think that things started to break. I mean, you saw the pound get to parity or almost parity, and the euro got to 96 cents. And then the hidden fissures that you never know exactly where they are. But like you said, the LDI pension stuff. Actually, I have a pension slide coming up in a bit. But the system started to crack, essentially. And so when you see the system crack, they basically knew that they needed to do something. Otherwise, it was going to, the bear steepener is the killer of the modern financial markets. Like, there's nothing they can do in that scenario. And if you go forward, there you go. This is from my buddy David Dredge of Convex Strategies. We had him on our podcast last week, and he runs a tail fund he's a tail fund manager, very smart. He's been in the markets for 40 years, and he shows you there bull steepeners, bear flatteners, bull flatteners, but there are not very many instances of the bear steepener. It's like a unicorn, essentially.
Oh yeah.
And the reality is, and I have been advocating the steepener because I don't like the long end, but I have been long the short end of the curve on some of the SOFRs, and the 1 year forward is basically the best way to think about it. But it's interesting because after Trump and that debate, you had about 3 days, the bear steepener started to come out again, and it just keeps rearing its ugly head. And that's kind of probably the biggest risk. Like, to me, if we just have a recession, then it's going to be okay. People will buy bonds, it won't be fun or anything, but the system's not really at risk, because my view and David's view and there's a bunch of guys' views, the real risk in the system is the uncapitalized risk, which is the bonds, which is the mortgages. And if you think about the fact that Silicon Valley Bank went bankrupt holding treasuries, think about that. They were holding treasuries, they went bankrupt. That just shows you the what it is. And also kind of probably is why the BOJ is so reticent to raise rates.
Of course, yeah, no, 100%. They're there. No geography has more exposure to its own sovereign debt market than the Japanese, than Japan. So very clearly, that's an issue for them as well. And I think they're taking cues from what we learned in the UK in 2022, and obviously what we've learned in the US in the fall of 22 and fall of 23, and that's kind of got them, very reticent to move, which I agree with. What's this next chart here?
So this is basically something I created earlier this year, or maybe it was last year. But if you look at since COVID, right, there's been winners and losers, and they all are symmetric around the peg that is the RMB USD. Now, this is the CNH USD, and you can see it's starting to weaken. It's drifting up a little bit. But that's like the most important variable. That and the yen versus CNH are the most important variables, really. You can see the green line is the total debt in this, the total US debt. So that's up, I think, 40, 50%. And this is since January 2020, so right before COVID. And then you look at all the measures that save you from inflation, stocks, that's the MSCI world, you have oil, gold, they're all up around the same. There's some variation in that's an idiosyncratic in each, but they're all about tracking that amount of incremental debt. And then on the other side, you have the Japanese yen versus the dollar, you have the bonds, and you have Chinese stocks as the loser trades. And look, there's more than that, but these are I'm just pointing this symmetry out. So we're in a world where the average investor and the general narrative is that the fiscal dominance or fiscal deficit spending, is what's going to keep happening. And under that scenario, we get this, where the private sector in the US wins, the private sector in China loses, the Asian currencies lose, and then basically you get inflation in the West. So China's exporting, but basically we're trying to eat the inflation and China's trying to eat the deflation, and it's a giant game of chicken in essence. So, China is in a situation where they don't have to devalue. They have a big trade surplus. But if they were to devalue, you could see a reversal of this. You could see U.S. bonds do well, U.S. stocks not do well, gold not do well, and then you'd buy Chinese stocks, probably buy the yen, and that would be probably the major macro trade out there in the markets today.
What do you think about the risk to China that would come from a devaluation? And the reason I bring this up is that we've had for almost 10 years now, persistent capital outflows from China. Obviously, those are retained earnings abroad because you can't really get your money out of China. If they devalued in a material enough way to change what we're talking about here on this slide, then would it not create a more potentially destabilizing, sort of capital outflow situation in China, where pretty much every asset that isn't denominated in renminbi becomes on the bid in China?
If they can get their money out, right? I mean, I think if you look at like Hong Kong and some of the avenues where they can, I think the money is trying to get out. I think gold, Bitcoin, these things are ways to gain some hedge against that. I don't have a personal, I lean more in the devaluation camp, but I'm very aware that they don't have to do that. But they're sitting on a black hole of capital misallocation, essentially, from all the trade flows over the years and building opera houses in tier 6 cities and the railroads and all this stuff. And look at the countries, and the infrastructure is amazing. But
it is. Having been to mainland China, it's fantastic.
Yeah. And look, I've been there a lot over the last 15, 20 years, and they did a good job of really getting it up to speed. I mean, I wish we had that infrastructure.
Totally. I would trade their infrastructure, theirs any day. Yeah.
But we always have to remember, with capital allocation that doesn't service the debt, right? And your cost of debt isn't met, then it's essentially it's a drag on GDP, right? And so all these cities that were built with the hope of like the Field of Dreams, you build it and they will come. And a lot of them, they didn't come, so they're blowing up cities that they built because the level of capital misallocation is on the verge of like $30 trillion, but in real estate it's about 10 trillion. And if you just say 5% on that a year, that's $500 billion drag to GDP, right? And then add a couple trillion up, it gets real, right? And so you see they have a lot of deflation in that country as a result. They have a mountain of internal debt. They're the most levered country in the world. But again, because they ran the trade surplus and it's a command and conquer society, they are not necessarily like they have to devalue the way you would think sometimes in other emerging market situations. But there's clearly a lot of stress. Like in the last week, I think they've had 40 banks absorbed.
Absorbed. They make a lot of stuff, by the way. I tracked everything the PBOC does, and the list is now spanning multiple pages now in terms of all the different policy levers that they pull. It's really just, in my opinion, it's a response to what you and I are talking about here, which is the capital misallocation. On one hand, they understand that they have these structural headwinds to economic growth, but there are those structural headwinds on the side of a balance sheet that says we need to pull more people out of the rural China and bring them up into the modern economy. And so they have to balance their development objectives with the economic reality that there is way too much debt. This is private sector debt to GDP. It's rivaling what we saw in Japan prior to the 1990s. And then you look at investment as a percent of GDP, it peaked out just shy of 50%, which is 1,500 basis points higher than what Japan peaked out at prior to its secular debt deflation. So we're very much on the same view that, they're trying to stuck between a rock and a hard place, right? They need to stimulate to prevent a Japanese style deflation. But the problem is that the stimulus that they've done in previous cycles has contributed to a lot of capital misallocation in the economy. So I don't really know how they get out of that, but my assumption is that they're probably going to do more now than later.
Yeah, I think before all that excess just went into the property markets, right? And the property market has cracked. And I think if you think about China post-COVID, they peaked out in about May of 21 when Evergrande blew up.
Yeah.
And I think that's basically was the end of the small cap rally in the US too. Cyclicals, that was it. And it's not like a coincidence. And since then, that equity market has been terrible. And I own some Chinese stocks. I own BYD, and I own Baba, and I own Baidu, and a couple of those kind of guys. But it's just because it's like, hey, if they're so beat up, and if this ever changes, they can have a major revaluation. We've had a couple false starts along the way this year, but no one owns China. Everybody's in India and in Japan, all the Pan-Asian funds. And if you're an American there, you're in India or Japan as well. You got to be a masochist like me to be buying Chinese stocks.
I respect it, man. All right, let's get back into your presentation, man. What are we talking here on U.S. corporate profits?
Okay, so let's talk about the fiscal. So you run a big fiscal deficit, and that means basically private sector surplus, right? And so if you go to the next chart, actually, you can see the blue is the percentage of profits represented by the federal government deficit spending. So you can kind of see that all this corporate profit, largesse, if you will, up to 3.2 to 3.8 trillion, depending on how you calculate it with inventory and capital adjustments. It's funded by the government, right? And so if you go to the chart before, you saw that we're at the peak of margins as a percentage of national income. The S&P margins are like 14, 15%. And so the general attitude to me, without making a prediction, is that fiscal will go on forever, and that the private sector will just keep absorbing it. And, you got to be long market and all this stuff. And so it's not so much, and, I think when we talked on the phone, I said, where are the fragilities? Not necessarily what's going to happen, but where are the asymmetries? And one of the asymmetries is this idea that bonds are a sell forever. The government's going to run this fiscal deficit forever. And then the private sector, gold, all that stuff is going to be the winner forever. And just to push back a little bit, that it doesn't have to be. And if you go to the next slide after that one, this is something I thought was interesting. Historically, you've seen a decline in government spending after the election year. And if you read what Trump and these guys are talking about doing, because I'm going to assume right now that Trump's going to win, it could have not, again, prediction is what it is, but he's the favorite right now by a pretty wide margin.
Yeah.
They're talking about gutting the agencies. They're talking about running tariffs that will take, the 3.2 trillion of imports we have, and we take tariffs of 4%. I think Goldman estimated that would get up to almost 20. Now, it doesn't mean they're going to do the 60 on China that he said. Trump has he likes to talk. He doesn't mean that necessarily. But the point is, if it goes up, that could be 400 to as high as 500, billion dollars. That cuts some of the deficit, and someone's got to take the hit on that, right? And then if they cut some of the spending out of the agencies, maybe they do a little restructuring. And then let's just say I'm right, the interest rates come down, or that the market's right. Forget about me. Like the market's pricing in 100 to 125 basis points of cuts. Every 100 basis points is about, $100 billion of savings. And since 30% of the treasury debt outstanding is in bills, so short, less than 1 year maturity, it will be felt. And so you could have, 300, 400 plus 200 savings. you could have that deficit get cut in half, which I think is dollar positive. That's not quite appreciated. And I don't think it's good for corporate profits, because if you look at 22, everybody likes to blame the Fed for what happened. But I do think the Fed hit the long duration stuff, and that didn't really come back. But what hit the whole market was there was a $1 to $1.5 trillion year over year deficit decline, right? So that hits corporate profits, that hits liquidity. That basically that fire hose went from this rate to this rate, and then the stock market felt that. But it was a double whammy, right? Because then the Fed also was jacking up rates at an unprecedented pace.
We're also seeing that right now. We're actually starting to see some of it now. The deficit is starting to contract. So if you look at this is our fiscal policy monitor, where we're looking at puts and takes across the budget, the federal budget through the lens of revenue, expenditures, and the balance. And we see that, through December of 2023, on a calendar year-to-date basis through December of 2023, the federal budget was up. The deficit was $364 billion larger than it was in 2022. Even on a calendar year-to-date basis through May of 2023, it was actually $700 billion larger the deficit was. Now the deficit is actually $51 billion smaller on a calendar year-to-date basis through May of 2024. So we're already starting to see this move in the wrong direction in a year. Going back to your slide here, which I thought was a phenomenal slide, in a year where it shouldn't be going in the wrong direction. So what does that tell you? You think about next year in terms of the impact of the federal deficit on the dollar, in terms of creating a bullish dollar, which is obviously negative for global liquidity, and potentially creating a pretty more sizable slowdown in the economy than what's currently baked into consensus estimates that are calling for 2+% growth next year.
Yeah, and I think, look, it's been a really unprecedented period of fiscal expansion in let's call it peacetime. Although I guess it's not completely peacetime, but the amount of money that's been spent and jammed into the economy has been, on par with World War II, right? So, I'm not really sure how people can just sit there and assume that everyone's okay with 7 to 10% deficits forever. And there's definitely ramifications from this. And I think as a country, do you really want to just prop up the stock market in order to, lose our ability to who's going to buy the bonds? So it's just asymmetrically priced that's the scenario that's going to come, whereas there is other scenarios, and I think things are not priced for that right now, and sentiment is definitely not there.
Gotcha. Can I ask, just before we move on into the conversation, who is in charge of the system from your perspective, of your framework? Like, what entity is running the show, pulling the strings, if you will?
You mean in the U.S. or globally, or what?
Probably, most likely U.S., or preferably U.S., but globally, if you think there's a cabal happening globally.
Well, I think China is a major player. Yeah. I think the New York City and D.C. are major players, and I think whatever you want to call the European conglomerate of London, Brussels, Paris, and Berlin are like the three major blocks. I think the Fed and DC are probably in charge, but I think they're not as much in charge as they used to be. Let's put it that way. I think they're still the big dog, but I feel like there's some competitors now. I feel like China is a pure competitor, and I feel like all the smaller competitors are all kind of organizing like a union, if you will. They call it the global south. And so guys are like, hey, this game's not really working in our favor. And you're seeing all over the place cooperation, if you will. And then they're all trying to rally around gold as their currency, their neutral currency for commodities, so that you could clear in gold. I just saw Tanzania just bought a bunch of gold. All these central banks are buying gold. Why are they buying gold? It's usually you buy gold when trust is going down historically, right? I view gold as just something that humans latch on to because it's time tested. And so when we're in periods where gold's in demand, it's usually because it's a lack of trust in institutions domestically and between countries, essentially.
And fiat currency is an institution that we've all come to, take for granted. But in the reality is, in this sort of multipolar world, you and I have talked about the fourth turning. We're big believers in that. generational kind of roadmap, if you will, in terms of how that can create some geopolitical consternation. Yeah, gold seems like an obvious winner here from a long-term perspective. I don't know that gold is a obvious winner. Going back to your presentation here, Colin, put the slides back on the screen if you mind. Going back to your presentation here, if this happens, it seems like gold could be in for a world of hurt alongside stocks, because obviously we know that things that are inversely correlated to liquidity, namely dollar, interest rates, gold, those types of factors, those are the things that tend to create problems from a liquidity standpoint. So you could be having a situation next year where U.S. fiscal policy dynamics are contributing to a decline in liquidity vis-a-vis the contraction in the budget deficit. Is that something that is kind of part of your base case scenario, or is that too much?
Yeah, well, with gold, I learned at a young age. I bought a 100-ounce bar of gold when I was a grad student 20 years ago, and I lost a bunch of money trying to trade gold futures, even though I was bullish the whole time. So I kind of take a view of gold as it's a holding asset. And now, but I didn't really add to any gold in the 2011 to 2021 period. And I don't have the slide with me, but gold and S&P, there's something that's not well known, which is if you take a gram of gold, it usually corresponds to the value of 1 dividend per share of the S&P. They're both right around 3%, and there's divergence over time. And usually when that divergence is one way or the other, is usually a good signal to go paper or hard. And then that's when, you'll have a commodity, you've seen those charts where there's commodity bulls and then there's paper bulls. And it feels like to me is that we're on the verge of the commodity bull. The paper bull's kind of at the end of its ropes, if you will.
At the zenith. I appreciate it. Well, let's go back into your presentation, man. Let's shift gears a little bit. You got some slides on convexity and pricing of risk broadly.
Yeah. So again, like what's priced versus what's possible. And one of the things I've been doing a lot lately is we're trying to create a product that offers people financial insurance. And there's that Warren Buffett quote about buy insurance when it's cheap, not when you need it. And this chart is a composite of 5 different cross asset market risk premiums and doing a percentile. So what percentile is it of the last 18 years? I think it goes back to the beginning of 2006. And if you see the red circles, those were all periods where the most risk had been built up. So how does risk get built up? Usually it's banks selling structured products and carry traders doing what they do, which is riding that carry trade until there's no meat left on the bone, right? And it seems that we're at one of those periods again. And so you think about FX falls cheap. I mean, everybody, talks about equity vols extremely cheap, implied correlations at the all-time low. The top of the high yield stack is at the 1 percentile. Investment grades are at the 1 percentile. So, you don't know exactly what's going to spark the fire and when exactly it will happen, but buying protection is a good idea now because it allows you to drive faster in the sense that you don't have to worry about, oh, this is the week to sell my stocks and getting in, getting out. That's one mistake I've made over the years, being bearish all the time in the face of a government who continues to devalue the currency, and the equity market is the best expression of maintaining your purchasing power. It's a tough game to play. S&P, if you look over 100 years, it's up and to the right, right? But there are periods of serious drawdowns. And if you look at where these red circles are, those are the periods where everyone probably felt the best. And on Twitter, they were telling you, have fun being poor bears, stuff like that. And you see they're usually subsequent to some kind of risk-off event, whether it's a minor risk-off event like the Volmageddon, which just clears the carry traders out and some bad players, or it's something more serious like the GFC or the EU crisis or COVID, something of that nature. So I guess the point of this is, and it goes back to what I was saying about fragility, it's like, where are the fragilities? And so what we just talked about is the private sector and the markets are not pricing much in the way of risk right now. The price of liquidity is extremely cheap.
The price of liquidity is extremely cheap. That's another way of saying the liquidity is extremely abundant from a supply perspective. So
you're not getting compensated for it is the better way to think about it. Carry traders get paid for providing liquidity. If you part with your money, cash is optionality, right? So if you're like, hey, I buy a bond or I buy a stock, you own a claim on future money, right? You don't own money, although some people think they do, but a security is a claim on money, and a money is basically claim on energy or services. And so energy
on a unit of human time.
What?
It's a claim on a unit of human time.
Right. It's a which is energy, right? So the base money of the system is energy, refined energy, and services, and then gold's the most pure version of that because it's stored and it's impossible to replicate, even though Isaac Newton tried really hard to do that. But then why do central banks own gold? Because they believe that's money. And then fiat is a claim on energy, and then securities are a claim on future fiat, which is a claim on future energy, essentially. That's the way I think about things. And so, if you're going to buy a stock or you're going to buy a bond, you're foregoing liquidity in the hopes of getting paid extra on your energy, on your stored wealth, right? And so you want to do that when vol's at 80, right? Like the implied forward returns are so much higher from an initial condition standpoint than they are when you're not getting compensated at all for liquidity like you are now. Now, that doesn't mean stocks and risk can't keep working. What it's saying is you're not being compensated very well for parting with your optionality that is cash.
That makes sense. So what are we showing here in this next chart?
Just another version of it, and I know everybody knows stocks and put options. So versus me talking about FX butterflies, you can just say a normal put spread, and you can see the cost of that going back over 20 years, and we're at the lows, right? So,
geez, and this is not a complicated derivative structure of 5%.
No, it's just 15% out of 95, 85, 6 months.
Yeah, this is.
You think about it, right? So you can buy for 1%. You can buy protection, and you're only taking 5% basically of risk for the next 6 months for that piece of the pie. And I've been talking about this a lot lately. There's a lot of different unique ways that you can buy insurance here. And you can sleep easy at night, but the thing that's weird, Darius, is that everybody likes to buy, or maybe they don't like to, but they're very fine buying car insurance and house insurance, and they're used to that. But people really hate buying financial insurance. They look at it. The only guys who like buying puts are speculators because they want to make the money, the bears, right? But just if you took it as, hey, I got an S&P allocation or some combo of that, and I just regularly buy this stuff when it's at the right price, the returns over time are far superior than if you did a 60-40. But people hate it. It's impossible to get people to think like that. And then, what happens is you buy it and then it doesn't work. And you're like, oh, I'm just wasting my money, or I'm throwing away P&L. And so it's an interesting dynamic, essentially, that when it's the cheapest is usually when people don't want to buy it at all. It's funny.
Well, of course. I mean, it makes sense. It's an institutional performance chase. So why in the hell would you want to be in a market that's a raging bull, doesn't go down? Why would you want to be giving up performance to bet on the left tail? There's more career risk in underperforming in that scenario.
I think that's right. So I think that's actually hitting the nail on the head. Is everybody in this industry is a benchmark chaser on a single year period, and there's very few people who are looking at what's really important, which is long-term compounded returns. That's all that really matters. But our industry doesn't have any way of compensating on that. And there's no metric for that other than, okay, in 5 years, what was your CAGR or your IRR, if you will? But that's the better thing to target. Whereas everybody's basically using silly things like a Sharpe ratio for 1 year periods because Wall Street is compensated on a 1 year period, but that ends up sacrificing long-term returns. So it's an interesting dynamic where the way that the industry is structured is actually worse for investors.
Yeah, no, that makes a ton of sense. Yeah, I mean, although we do know that the buy side is very good at getting itself paid. There's been a litmus.
Definitely are.
Yeah, there's been a litany of studies on this. The investors are usually at the back of the line, and we don't mean that in a disrespectful way. Obviously, there's a ton of buy-side clients, so shout out to all you guys out there getting paid. What's the next part?
This is just another one, it's credit spreads. And one of the things that's interesting is you can see there's a dispersion within high yield right now where the triple C's are trading pretty wide and the B's and the double B's again are at the 1 percentile. And what you see is you saw that dispersion before 2020 and before 18 as well. And, it's just another leading indicator that the weakest of the weak, whether it's in the real economy or it's in the corporate credits themselves, or I don't think I put this chart in, but if you look at strong balance sheet performance versus weak balance sheet performance of equities, there's been one of these, divergences as well. So the K economy is a very real thing across the board.
That's one of my favorite things I talk to our clients about, which is, I've been trying to beat it over their heads that, this U.S. economy has been resilient. We authored our resilient U.S. economy thing back in the summer of 2022. And one of the key linchpins of the theme was understanding that this whole concept of excess savings is wrong. People are approaching that from the wrong perspective. But even if you're approaching it from the perspective that it's generally approached from, which is how much money do poor people have relative to where they started with prior to the pandemic, and that money is now effectively at zero. If you look at certain studies by the San Francisco Fed, New York Fed, et cetera. But the thing we keep coming back to when we're pushing back against those views, which is, yes, the U.S. is a K-shaped economy. The bottom part of the K is tapped out. So let's say this was the length of the K. It's now, we lost some of that length of the K. Now it's a smaller part of the K. But what people are missing is the fact that in this K-shaped economy, the bigger part of the K is much larger. The top part of the K, the vector is longer. It has a greater length. And so as a function, and how we determine that, is just looking at consumer spending. When you look at consumer spending by income cohort, the lower third of consumers by income cohort only account for 15% of consumer spending versus 51% for the upper third. The bottom half consumers only account for 30% of total consumer spending versus 70% for the upper median. And so the reality is, as long as stocks remain in a bull market, as long as you go back to this kind of dispersion that you're seeing in the credit markets, and you can extrapolate that across private equity portfolio companies that are getting financed by private credit, et cetera, that top part of the K hasn't dwindled enough to cause the sort of corporate profit machine and the liquidity machine to really stop functioning.
Yeah, I would push back a little on that. My buddy Rupert Mitchell had a piece on his Substack recently where he showed the price of fine wine is down 35, 40% in the tradable market, 30 on the index. Rolexes are down 25 on the index, 35 on the tradable market. Birkin bags, which never go down, are flat. So, I know the art market's actually pretty soft. I heard Art Basel in Switzerland this year was hardly anybody. So you're just, I know that's the narrative, but I think I have a lot of friends with a lot of money who are much more frugal now than they were in the past. And so I hear you. I don't think that they're on the poor street or anything, but I think that there is still some behavioral changes even in the upper bands of this. Inflation sucks. It's a reality.
Yeah. Oh, I don't disagree with you. I think we're arriving at the same conclusion. The conclusion we were arguing, for the last 2 years, which is the economy is going to be fine. We're not going to go into recession. But I think we're arriving at the same conclusion cyclically, which is there is a softening going on in the economy. This is the first month. Last month in May was the first month we saw consumer spending on services go below trend for the first time in a year plus. And so that's, I would agree with you on the directional travel, mode of travel, but we're not there yet in terms of the blow up risk, in my opinion.
No, I think that I'm just talking about the trend, right?
Yeah.
You're seeing the excess savings, but then you also have had almost $1 trillion of credit between the buy now pay later and the credit cards, and then a decent amount of auto. So you had the 2 trillion in savings that have gone down, and then you add on all that credit. That's basically now where I don't think on the increment that's going to be there for them, right? And so as we see the jobs market start to roll, especially in the white collar, higher paying jobs market. I don't know if you've seen the chart of software industry, but it's not a great time for software engineers, and that was a high paying. As you know, Wall Street isn't it wasn't the industry we started in for a while.
No, the industry you started in. I started in 09. I was making $35,000 a year my first year in this business. Obviously making a little bit more now, which God willing. But yeah, no. I remember used to be able to call someone at Yale. Like literally, you just call someone. They didn't know who you were. You say, "Sir, can I have a job?" They say, "Yeah, when do you graduate?" I said, "Oh, 2006." "Oh, sure, absolutely. What do you guys want? What do you want for base? 250? Is that good? Sure, why not?" That's how it worked on the Yale Football Network. You can't do that anymore. So
that's good. It's good times, man. It was good times.
Absolutely, good times.
But yeah. Anyway, the point is, I agree with you, and it's not that like this has to be a destructionary event like it was in 07, but it's going to just be more of a slow, great stop loss. And so the weak, whether it's the weak countries, the weak credits, the bottom of the economy, just they're the ones getting hit, and it moves its way up is the way I would think about it.
Gotcha. I like it. So what's this chart telling me here? Let's get back into the side deck. I'm loving this.
Okay, let me see. Yeah, this was the Goldman chart of the day yesterday, and it just showed the gamma imbalance in the stock market, which means that basically they have to trade against the market at a level that they've never done before. And one of the things they're doing, the option dealers are doing and some of it's from call selling ETFs, which has become a decent amount of AUM, but there's also just, speculators, Citadel. They're shorting the VIX against their S&P gamma in order to try and like slow the theta burn, the decay essentially. The VIX expiry is next Wednesday, and then OPEX is next Friday. So we'll see when you get through that. Then we have earnings coming up, starting with Jamie Dimon on Friday. So maybe this like low vol period we've just been in will start to change a little bit starting next week, or maybe starting Friday. But the dealer positioning probably can unclench next week, I think.
Gotcha. And what's the implications of that?
Just that things can trade more freely. Like when you have that kind of hedge, or you have that kind of buildup on the book, basically they need to trade against the market in order to hedge themselves. Gotcha. So you have basically, that's how you have the S&P realized vol for the last 10 days is 5. And the implied correlation is 4, because guys at Citadel are basically, they're going long single stock vol and shorting index vol, and it's just the valve, if you will, that allows them to make money is they're selling correlation. And now, it's at 4. Where's it? Can it go negative? I said that to a buddy the other day, and he said, well, oil went negative and bond yields went negative. I was like, it's a good point. Who knows?
Yeah, we're living in crazy times, man. Let's keep moving here. Let's get back into this check. Colin, keep this chart silent.
So yeah, it's just the same thing, right? It's just the valuations are at the peaks. The other chart on the right is interesting because it shows the amount of new lows despite being at the peak, and you can see the periods where this phenomenon happened. And I would bet if we overlaid it with my risk proxy chart that you would see those red circles probably are similar to where these blue bars are.
No, I like this. That's a great chart there. Yeah, this is similar, not similar to, but it's in the same direction of our global macro risk matrix, which we use the nowcast to market regime. It's got 42 features in that model, all market based. And one of the things we that's been really beneficial from the context of that model is we don't care which feature takes us into a new regime. It could be the Mexican peso, it could be the Chinese renminbi, it could be it doesn't matter to us. It's the speed, it's the direction of travel in the composite signals. And so this is telling you that there's something brewing underneath the surface that's causing this level of new lows, this sort of high frequency of new lows that is not yet being reflected in the index, which, going back to your gamma chart here, that's probably why it's not being reflected in index alongside some of these other more supportive liquidity measures that we've been talking about with the Fed and with the Treasury. If those things start to unwind a little bit, then that's what that could be the sort of pulling the pin out of the grenade, if you will.
If what a good analogy is for some of your listeners is, hey, spending can keep going as long as you can expand your balance sheet, right? So you can blow your credit card out and go have a fun summer in the Mediterranean. And if you're just looking at your spending patterns, you're like, oh, everything's good. But they don't know that building risk is on the balance sheet, right? So there's these hidden like risks that are sitting there where it's being balance sheet, whether it's gamma, it's credit risk, whatever. It's the same concept, I think.
Yeah, gotcha. Well, we're kind of getting close to the top hour. I did want to end on this final chart. Real rates are positive once again. This is a fun chart because you see that we've been in this negative real interest rate environment for pretty much most of my career, since the middle of 2009. We're back to positive again. What are the implications of this?
So yeah, that's right. Basically, my career also, buddy. And it's valuable because I if you were around pre-08, it wasn't a big deal having real rates, having higher rates. It was part of the game. And then I think in 07, 08, the system broke, and essentially they, instead of cleansing it and taking it fully, we've just been on life support by the governments. And so you see, like in 18 and into early 19, where we had that little, you got to look really hard to see those green lines right there where Darius circled. Yeah, exactly. And then by the fall of 19, we had the repo crisis. And then, look, we don't need to get into this, but COVID had a lot more to do with some of this stuff than just the virus. There was a bunch of built up risk and lack of liquidity. And then, so, we're back now. We have 3 months of positive real rates. And by the way I'm measuring it is the SOFR curve and using Eurodollar or policy 3-month rates prior to that, because SOFR's only been around for, certain number of years, it's like 6 years or something, minus the 2-year average inflation. So I'm using CPI, which I know some people don't love the BLS, but whatever. I'm just using it because that's what everyone uses.
Apple size. Yeah.
Well, we've only had 10 months of positive real rates since the GFC calculated like this. Wow. And if you calculate a 2-year average SOFR minus 2-year average CPI, 0. And so in a system with 3.5 times leverage, non-financial credit to GDP, you can't take on a lot of leverage, and the government can't delever in a positive real rate environment. So it comes back to, who's going to own the bonds and what are they going to be able to do? And it just is like another thing that's like the fragilities that we highlighted today. This can be one of the things that starts to enact, the next stage of this, I guess.
Well, this has been great, man. So tell the viewers a little bit about how they can find you, get in touch with you. You said you were raising a strategy. Talk to us about that.
Yeah. So I'm a partner at Wall Street Beats, which is a subscription service. There we have a broadcast and there's research that I publish on there. I have a Substack called Capital Misallocation. I'm on Twitter at my name, Ben Brey. And then, you can reach out to me if you're a accredited investor. We have a product that's basically going to buy convexity, if you will, and for the near-term future in order to try and give people a little bit of insurance.
Well, I love that, man. I'm looking forward to seeing your uptake on that, man. That's a great strategy you're running that. And you're running that with Nadine Turman over at Soul.
Nadine Turman and my buddy Tian Zheng.
Oh, man, that's 3 of the smartest people I know in the industry, man. So you guys are going to do well, man. Best of luck with that.
Thank you, buddy. Thank you for having me on.
I appreciate you having me, and we'll catch you guys back here next month. Everyone have a wonderful day out there. Cheers.